I see you're in New York. Patricio, you're in London? Yeah, I'm in London.
So maybe Mike, you don't know your skylines well enough. This is lovely Houston in the background.
I knew that. I was testing you.
All right, I think we've got a quorum, and it looks like our audio is all working. So good morning, good afternoon, everyone. This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange. On the call today, we've got Patricio Alvarez joining from London this week. His normal perch is Madrid these days, swinging across the Atlantic Ocean. We've got Mike McGlone joining from lovely sunny Miami, it appears, and I'm happen to be in Houston today. I'll kick off by just giving a quick update that the reason I'm in Houston is that we had a big event yesterday that was exploring the intersection of all the spending that's occurring around generative AI and what it could mean for energy demand. If you missed it yesterday, Patricio, myself, and the team have a very cool deep dive out. It's about 40 pages. If you want to really go deep on the topic of how data centers, essentially, the rise of AI could impact electricity markets, gas markets, demand for clean energy, traditional energy, please check out our note. We've got a pretty interesting thesis on this pretty apparent theme here at the moment, and we had a very good discussion on the topic. In Houston, we had speakers from NVIDIA, speakers from the energy industry, and kind of really getting the tech industry and the energy folks together to have a pleasant conversation. I do know that I believe October 24th, we're going to have a similar discussion in New York, still planning on kind of what the exact details of that are going to be, but stay tuned. I'll make sure everyone who's a regular on this call gets the details on that. And then in November, late November, Patricio and I will be doing events on this topic in both Madrid and London. So we're definitely going to try to visit as many cities as possible. Mike, maybe I'll come down to Miami before too long, and we'll do something there as well. So just stay tuned if you want to meet any of us in person, chat about AI and energy, or just energy generally. We're happy to help make sure you get looped into those conversations. So with that, let's just switch gears and chat about where markets stand at the moment. Mike, I always like to get the readout from you on just commodity landscape generally. You've got a very pronounced view on where you think markets should be headed. So give us the readout and current read of the tea leaves. Where's the energy complex headed? Where's the rest of the commodity space headed over the remainder of 2024 here?
Down. Unfortunately, unless you're short or a consumer, but most traders, it's usually not what they want to hear. I do like the word you use. Typically, I like the word provocative when I use my headlines, because I do have an axe to grind with markets. I think they were way too expensive. I think WTI is just a matter of time it prints 40. That's not profound. Certainly, if you analyze it going back since the Iraq-Iran war, which is the first time it printed up near 40. And then there's more substantial reasons now to go to 40, I think, than ever. And that's part of the massive shift, the paradigm shift in excessive supply versus demand out of the U.S. and Canada. China heading into pretty severe recession, potentially depression. I'm just looking at their bond yields this morning. 10-year notes 2.11. The U.S. 10-year up to 364. I think we're going there. The U.S. inverted yield curve, the steepest for longest. If you look at 30s versus 3-month bills, certainly since crude oil started trading in 83, just starting to disinvert early days. And then you fit that into the normal propensity for commodities to get cheap after they get expensive. They're getting there. So, and this is not unparalleled at all. It's very precedent. And certainly in the short term, grains have already somewhat got cheap. The grains are the most elastic. We've already had corn, soybeans, and wheat go back to prices that were first traded in 1973, maybe get near their cost of production, but probably not low enough. to really shut off that excess of supply, which is most notably coming out of Brazil and the U.S. The natural gas has done it. It's certainly dropped below its cost of production in the U.S. for a little while, down to about 1.5 or so per MMBTU, now hovering around 2, maybe get to near 3. And crude oil is just catching up right now. So maybe 75 is pretty good resistance. So you do get the best short covering rallies in bear markets. It's a matter of time it gets to 40. And you got to shut off that supply versus demand in the U.S. And, I mean, we just see excess surplus production of the OPEC rising and China demand declining. And I think China is in a recession tilting there. So to me, the next key shoe to drop in commodities is copper. Copper had a pretty significant peak around 520 on the back of very speculative excesses in futures, and they're still net very long, around 20% of open interest. To give you an example, when things really bottomed in 2019, specs were about 15% short. So everything else is completely sold out in commodities, with the one exception of gold. So gold's still way long in terms of specs, but it's still the bull market. So I'll end with this. I think gold's going to continue outperforming everything, most notably crude oil. That WTI, the gold minus WTI ratio around 38 barrels of TI through gold, bottom around 7 in 2008. I think it goes to 60. 60 is not so complicated. That means 3,000 gold, 50 WTI. It's not too far away right at the moment. Key question is what stops that, and that is that you need some kind of shift away from this tilt towards U.S. recession, and U.S. interest rates are just getting started, the cuts, and typically takes a long and variable lag from the bottom of an interest rate cycle for commodities to bottom. So to me, this is just getting started. It's a great reset. It's very deflationary. And the next shoe to drop is copper, but in the big picture, it's just a little back and fill in the very expensive U.S. stock market. Back to you.
Yeah, we're going to have to get you and Jeff Curry in a room together. You've got the anti-Jeff Curry thesis. Very interesting.
I've known Jeff for decades. In fact, we're friends. We were neighbors for a while. And I've spent a good portion of my career fading Jeff. And now it's also, as an ex-trader, oftentimes you'd be on a trading desk putting positions, economists come out and say something, you say thank you and do the opposite, partly because it's already priced in. So Jeff and I are friends, but unfortunately from a trading standpoint, when he gets really bullish crude oil, a lot of traders turn around and hit bids. And same thing just happened at copper. It's such another fade Jeff signal, and I don't want to push back on Jeff, but sometimes people are very good contrarian indicators. I have been for periods. Right now I've been more on the hot phase, and I'll go back to being cold. But it took me being really cold at first. Remember we talked about $50 2 years ago in WTI? It's just the cycles are all heading that way.
No, fascinating, and I say that with nothing but respect for Jeff. He's a very interesting thinker in the commodity space for sure. Patricio, let's swing over to you. I'm just looking at the screen. European gas is still hovering kind of 35 euros a megawatt hour. So it's been a little bit more resilient despite some downward moves in most of the rest of the commodities that Mike was just walking through. So let's just get a check-in from you. How are you reading the tea leaves on European gas as we head into winter?
Sure. So I think while it's still, European gas still hovering around 35 euros a megawatt hour, it has come down from that 40 mark it hit about a week ago. So in that sense, I think our fundamental view is playing out. That demand will disappoint domestically. Year over year, demand is poised to decline another 4 to 5% after a drop of about 20% from 2021 to 2023. So that's very, very, that's very substantial, and we think a lot of that is structural. So we think at least 2/3 of that won't come back. And I think that plays into recent headlines about automakers in Germany trying or expecting to shutter their operations there. So I'm talking about Volkswagen, because Europe is facing sort of structurally elevated energy prices, very weak demand. Storage is even higher than where it was this time last year. There are a few, let's say, headwinds in terms of the supply or supply risks, but these are supply risks that have been lingering or simmering throughout the whole year, and none of them have materialized. So we're talking about temporary outages in Norway. Now I'm reading on the news that there's a potential outages for LNG exports in the U.S., but these are all sort of small, let's say, blips or temporary sort of drivers of volatility, but I think the fundamental view is still the same. We think that 35 is sort of the upper range for us. Our range goes is pretty wide from 25 to 35. But at the moment where demand is, we think perhaps the lower range is sort of more the fair value.
Patricio, I'm going to bring it back to this again. So one of the interesting things that you will note if you take a look at our deep dive, if you think about rising electricity demand and how that demand is going to get met, I think there's a very interesting distinction between how you want to think about the U.S. and how you might want to think about Europe. So in the U.S., we think that this sort of voracious energy demand picture that seems to be unfolding, driven by data centers, but also EVs, also manufacturing resurgence in the U.S. Gas is not the only part of that story, but it's a pretty big part of that story. And we see a very strong upside case for natural gas demand as a result of some of these big energy movements that are occurring. But as you note in our report, gas may not be positioned to play a similar role in Europe. So I wonder if you could elaborate on that and talk a little bit more deeply there.
Sure. So it's a very fundamental difference in the way that the U.S. energy landscape is composed, and the European one is. So Europe is a net importer of fossil fuels. Gas reserves have been in structural decline for more than a decade in the North Sea, and there are very few sort of pockets of new reserves for gas in Europe. So in that sense, in Europe, we're sort of we're shackled. We need to import our gas either via LNG, less so from pipelines from let's say not necessarily friendly countries. So in that sense, yeah, we think this is the reason why European gas is nearly 4 times as much in price as U.S. So yeah, European gas is almost 4 times as much despite this weak demand, despite everything, and that's because we're a net importer and we need to keep on bidding for cargoes with Asia. So we need to outbid Asia to bring those cargoes here, and that's mainly a result of policy. So the Repower EU plan and the EU Commission is very much adamant in reducing exposure to fossil fuel and consumption, because really there is no other choice, let's say, for the continent. Because if we want to cut reliance and we don't have production, we need to build renewables and try to use as little fossil fuels as possible. And yeah, that is exactly why I think that the story is very much different in the U.S. The U.S. is one of the largest exporters of LNG. I think it still ranks as the top exporter of LNG at the moment. There is, in terms of what the coal phase out, so switching in gas for coal, that process is much more advanced in Europe. So we're kind of in the later stage of that section of let's say a demand driver. In the U.S., that still hasn't happened. So that's why the runway for gas demand in the U.S. is much bigger. As you alluded to, obviously there's fundamental factors like manufacturing, AI, and just that the economy at the moment is much stronger as well. If you look at a chart of the U.S. Gas demand, it has increased over the past 20 years, and it's poised to increase 3% this year. And Europe seems to be going in the other direction.
Thank you, Patricio. Mike, I want to come over to you. I just have an observation that, you know, it's always hard to avoid the intersection of energy markets and politics. And last night, after following up the event, I was out at a client dinner, and the U.S. presidential debate was going on. It was on mute up on a TV screen. I didn't watch it. I haven't even seen any clips. You know, both candidates look fairly composed up on the screen, but I have no idea what they were talking about. But I do know that you have a note out, just either, I think it was today or yesterday, that said gold crude may head towards 60x even if Harris defeats Trump. So I want to get a sense from you. How does politics, if at all, really feed into some of the market dynamics that you're thinking about?
So it's a virtual certainty. If Mr. Trump is reelected, we'll have drill at will, a lot more supply of crude oil and fossil fuels, pushback on renewables, and pretty significant pressure on the dollar. I mean, he's pushed back in the Fed. He stated he wanted a weaker dollar, and even my colleague Audrey Child-Friedman has written on that. So we've coordinated. Now, I'm not allowed to write about who I expect elected, but I fully expect Kamala Harris is going to be elected. And you can really see that. That's my sense of what I think people are sensing in this country. What was, you can really see the juxtaposition last night. I came out with the word grog. Grumpy old rich guy is what Trump looked like versus the potential first female president. And I think it's amazing how quickly things shifted. Now, he's an incumbent and she's not. She was a vice president. So to me, that's the sense what's going to happen. And that means more of the same potentially. But one thing I do like to point out is the U.S. became a net substantial exporter of liquid fuels and crude oil during the Obama administration. And it at least accelerated during that. So, but the difference is if Trump is elected, which I don't think will happen, expect crude oil, the pressure to continue and gold to continue higher. Those are pre-existing trends, but I think they'd accelerate if he's elected. So politics have to play a role now, and I think it's also in the stock market. To me, the market as we speak this morning is already down 1% in beta. S&P 500 was up 0.5% earlier for a little while, and it's partly because I think the market's realizing we do have a contentious election. We still have a sitting ex-president who still has not accepted the results of the last election. There's a risks of the not so fluent transfer of power, just based on facts. And so the market has to take, and it's priced for perfection. And we all know what happens when S&P 500 drops 10%, crude oil drops 20%, gold usually goes up. To me, that's what's happening now, just going back to a normal bear market reversion. And so these are more trader instincts, but I'm sensing it every day. I'm seeing the flows. People are buying bonds, buying treasuries. You can get a pretty good premium U.S. treasuries over anything in the rest of the world, most notably China, which you can't really buy. The Fed's going to be easy, and it's a great environment, and I think they're selling risk assets. Certainly started with Bitcoin peaked in March. The fastest horse in the race, to me, is telling us the race is over. And commodities are indicating this global recession. So I look at it as you cannot not acknowledge politics, particularly what's happened in China. China is no longer China, it's one person. And whatever that person does matters. And he's really pushing his country back away from being a demand pull source towards, and the rest of the world's pulling it. And I'll end with this. Just on the terminal this week was a significant story about Japanese disinvestment and getting out of China for the most significant period in decades. And that's global.
Okay, thank you, Mike. Interesting view on the election. My sense is that things will be pretty close. I think it's a hard call. While Biden was still in the race, I think it wouldn't have gone in the Democrats' favor. I think it seems a little bit closer now with Kamala Harris in there. And that's my Monday morning quarterbacking on that. I don't have too much else to offer, but I would say that if you do want to check out our deep dives, so you can just on your terminal type BI space deep. You can check out ours. It's the latest there. But then if you look, the one prior to that is by our colleague Nathan Dean and some of his collaborators who are based in Washington, D.C., and they go really deep on the election. They try to take his very neutral perspective. They don't know who's going to win, but they kind of analyze the outcomes, not just of the presidency, but also how Congress goes, because just who's the executive is only one piece of the equation here in the U.S., and you've also got to think about control of the House and control of the Senate. And Patricio, with that, I want to just swing back over to you, because I know you're one of the collaborators. Myself and you both worked with Nathan pretty closely on thinking through some of these political scenarios and kind of thinking through market impact. So if you could maybe share a little bit of insight, particularly on how some of the investments that your European utilities have been making in the U.S. I do find it fascinating that the U.S. is such an attractive market because of the IRA and other things that European utilities have been spending money over on this side of the pond. So anyway, tell us about how that could change or look different depending on how the election goes.
Sure. I think it's important to start with the context. So the European utilities, the U.S. represents their largest market outside of Europe. And we're talking mainly about renewable power developers. So you're talking about your Ørsteds, the RWEs, Accionas, and all these types of sort of greener names. These companies are destining or allocating 25 to 40% of their 3-year capex plans to building new green electron capacity in the U.S. And like you said, it's mainly because of the let's say relatively generous tax provisions that they're getting with the Inflation Reduction Act. But it's not only the Inflation Reduction Act. They started investing before the Inflation Reduction Act, and that's mainly driven by regulatory visibility, and also because the U.S. had very aggressive climate targets before the IRA. I think the IRA was just cementing those into actual incentives. In terms of how the election may impact investment, we think, and this is part of the result of our collaboration with Nathan, that there's only a 10% chance of a full repeal. A full repeal of the IRA would be devastating, I would say, to renewable development. Just mainly, it's basically taking out $26 per megawatt hour in terms of what revenues you can achieve, which in the case of onshore wind would render a lot of projects uneconomical if they're unsubsidized. That's the reality. We think that perhaps solar would fare a bit better just because solar has been gaining. There's decentralized solar going around. It's cheaper to build, faster to build. We think there's still sort of good demand for those assets. And I think perhaps the most credible threat is against offshore wind. Former President Trump has been very vocal in being against offshore wind. He dislikes it, and offshore wind is in a very weak state in the U.S. It's sort of in a very early stage of recovery. There's less than a gigawatt being installed at the moment, and while they have very ambitious targets for the next 6 to 7 years, the supply chains have not matured, and the development costs remain elevated in the U.S., and that has resulted in a string of cancellations, most notably in New Jersey last year, with Ørsted suffering multi-billion losses on the back of that. So in that sense, we think that there is a credible risk because President Trump could enact executive orders to place moratoriums on new federal permits for offshore wind. And that's kind of that would be sort of a retaliation to President Biden's moratorium on new LNG projects. So we think that would be plausible, and that could be very hurtful for offshore developers. And obviously removing the subsidies for offshore wind would be devastating for returns as well. We've did an analysis of returns where we see returns possibly dropping more than 500 basis points, which, if you consider that the weighted cost of capital of a company like Ørsted is 5 to 6%, that would make a lot of the projects uneconomical. In terms of what options European utilities would have, we don't see many with, say, the scale that the U.S. market represents.
Okay, great. Thank you so much, Patricio. And with our remaining little bit of time here on the call left, I want to shift and hit one other topic that we had a lot of good debate on yesterday at the AI event here in Houston, and that is about the future of nuclear power. So especially in the tech world, there's a lot of sense that nuclear could be a great technology, a great fuel for providing baseload power or dispatchable power for data centers. There's a whole crop of companies, NuScale, TerraPower, trying to change the game and bring SMR, small modular reactors, to the market. My personal sense is that these things are very interesting, I like nuclear, as a fuel and a technology. But it's failed in many ways to sort of find its way into the competitive market landscape. And there's a variety of reasons why I think that's true. But Mike, I want to come over to you first and get a sense check from you on nuclear. Because obviously one of the commodities that I don't think it's not a highly liquid commodity similar to gold or other things like that, but uranium is one that probably you occasionally look at, and I'm curious is uranium a commodity that the traders really actively trade? Do you think about that one at all in terms of the just global commodity landscape? Does it relate to oil, gas, or any of the other energy complex type commodities?
Not yet. It's getting more and more that way. I listen to a gentleman named Eric Tonstead every week with Macro Outlook, and he always points out uranium and nuclear. And I just want to back up one little thing that you both said, Patricios. I was in the Midwest last week, and I go right by Princeton, Illinois, which is right by Dixon, Illinois, which is where President Ronald Reagan's from, and there's a massive amount of wind turbines being installed in the Corn Belt everywhere, and I've seen that in a lot of land. I know people who are actually trying to lease them, but in that spot, that area, Microsoft just bought 500 acres of farmland for one key reason: to have access to that green energy, and they maybe have better storage. So to me, it's that trend of alternative sources compared to what we had coal, and then bunker fuel, whatever fuel, and now natural gas. But for creating electricity are just off the charts. I mean, I had a home, I installed solar on it 10 years ago. It was phenomenal. No moving parts. The only issue was storage. And we're getting there fast in the process of cheap storage and EVs and everything, and panels coming out of China is just exponential. So I see this as it's a paradigm shift in demand, at the same time, a paradigm shift in supply coming out. I mean, you can get energy from the sky now and from the sun. So the one issue I have with solar is the sunk costs. Now, I hear a lot of people trading it, but it's such a sunk cost. Sometimes maybe you can streamline maybe 5 to 10 years to get a decent plant going where you can install solar in a couple months and put up the storage, maybe have some wind, and you have a backup with natural gas. You got instant power that's green and much less cost. And that solar lasts you 30, 40 years. And there's no moving parts. It's shocking. And every year, every couple of years, you just slide in new panels that are more efficient. So I kind of go that way. But what I see is happening in this country, in the Midwest, which is not really talked about, and people push back on the offshore, but the onshore, what I see in the Midwest is just taking this piece of farmland, producing corn underneath and putting a wind turbine on it, and then Microsoft buying land because they can have the data centers is impressive.
Fascinating. On Twitter, I've seen a number of folks referring to solar modules these days as SMRs. I guess that stands for small modular receivers instead of reactors, from our great fusion source out 93 million miles away. Anyway, Patricio, let's do a quick check-in from you on nuclear. You have an interesting note out just the other day on Spanish nuclear, and I'm curious how nuclear may be faring in Europe, because I think it might be a little bit different story than how it could possibly go here in the States.
Yeah, sure. Sure. So Europe, I would say the majority of countries in Europe are in the process of reducing their capacity. So the note you just alluded to is just looking at what the impact on revenue would be on Spanish utilities, because they are being mandated to decommission their reactors starting in 2027. And that means, we think that means a couple of things. Not only is that nuclear power has relatively lower variable costs than fossil fuel technology, so we think there's a margin impact there, despite the fact that the decommissioning costs are being funded already by tariffs. And the other part is what it could do to the power market in Spain. For example, if you remove such a big chunk of baseload power, that means that will need to be plugged either by a dispatchable source, gas, possibly gas, or battery storage, which as Mike said, still sort of in the nascent, well, I wouldn't say nascent, but in the early stage of ramping up and scaling up. In terms of the broader sort of outlook for nuclear in the region, there's a divide, I would say, between Western Europe and Eastern Europe in terms of support for nuclear. It's mostly Eastern European countries that are supporting the build-out of new reactors, and we're talking about the traditional or conventional reactors that take north of a decade to get built if you're lucky enough not to run into massive over budgets and cost overruns and also delays. Like an example is Hinkley Point C in the UK that should have been commissioned nearly 10 years ago, and it's more than 7 times over budget, and there's no end in sight. We don't know when that's going to be commissioned. Notably in the West, in the Western countries of Europe, I think France is a standout because France has the largest fleet. It's nearly 70% of the whole of European capacity. They're trying to build new reactors. They've been proponents of starting, the development of SMRs, but so far there hasn't been any sort of material progress. We think SMRs could play a role, but it's just not going to be fast enough if it's to match the growing demand, especially if this surge from AI and data centers materializes. We think nuclear won't be enough or won't be there in time.
Okay, thank you so much, Patricio. We do have a couple of questions in the chat, and normally I would say we would run over and answer them, but I got to run to the airport to catch a plane, so we'll have to take that up next time. Anyone who's listening, this is an open conversation, so always feel free to pop questions into the chat, and we do try to answer them kind of as we go. We don't tend to come with a super prepared agenda for these calls. It's just more of a reflection of recent research we've published, what's going on in the market. I will be in New York City tomorrow, so if any of you want to grab a coffee during the day, I'd love to say hello. I will be back in New York City for Climate Week, so week after next for a few days. Bloomberg has a number of events related to that, but if you're there and you want to say hello during that week as well, give me a shout. As always, reach out to Patricio, Mike, anyone on the team. We're Green Dots. We're happy to chat about any of our research, answer specific questions you may have. So thank everyone for attending. And if you have colleagues or peers out in the industry who might find this call useful, feel free to share the details on how to join. I hope you have a great rest of your week, and I look forward to talking to you next Wednesday. Take care, everyone.